just 5 years away, and the amount of government revenue that will grow between now and then, a 22% portion of that has to go to the increase in people getting the pension, alone.
That's only in the next 5 years.
In the next 5 years.
So, that's nowhere near my retirement time.
No.
Not even really yours yet.
No.
That's really, imagine what that would be, closer to your retirement, closer to my retirement.
Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome to another episode of Markets, Mystics and Mayhem. This week we're going to cover a lot, actually. We're going to go through inflation expectations and how they're becoming a little annoying and what that could mean for monetary policy. We'll talk a little bit about the data that's come out recently, the PMIs, PSIs, card spend data, what that's telling us about the economy. And then we're going to get into some fun stuff and we're going to talk a little bit about demographics and the problem that just does not go away. And we'll bring that back to net migration. So we've got a lot we want to get through today. But to kick it off, Sabrina, what's happened with inflation expectations?
Some pretty ugly moves, actually. So first of all, for people who might not know inflation expectations, it's a survey from the Reserve Bank. They ask professional forecasters like Jarrod, he fills them out, and also industry professionals where they think inflation is going to be in 1 year's time, 2 years, 5 years, 10 years. And what we've seen is a lift higher across all those time horizons. Now, we have been seeing inflation expectations track a bit higher since really all of last year, given the actual lift in headline inflation. But there's just that persistently pull higher, and we've actually seen some sizable moves across some of the time horizons. So particularly that 10-year out, that's less sensitive to monetary policy, but that did lift to an all-time series high of 230.
Yeah, in theory, that should just be 2.
It should just be 2. So when we look at inflation expectations, we want them anchored at 2%. That's the Reserve Bank's 2% sweet spot. Thankfully, they are all still within the band, but we just have seen inflation expectations creep higher and higher and higher.
I mean, we are simple creatures, right? We see inflation lift and we go, oh, inflation's higher and it's going to remain higher. So it's one of those things like the best guide for inflation is actually the last print on the current print and maybe the next one. So there's a bit of that going on, but it's moving away from the target midpoint, and that's got to frustrate the Reserve Bank, I think.
Yeah, I think the Reserve Bank definitely would be feeling a bit of heat, a little bit of discomfort. Their credibility really, as inflation fighters, really relies on inflation expectations being anchored at that 2% sweet spot.
Yeah.
Because when they're not, it's a lot harder for them to do their job and actually get inflation down. We saw that was the case, post-COVID in that high inflation time period when inflation expectations had, skyrocketed for that 2 year in particular. And they're probably, why they're feeling a bit of discomfort is they don't want these higher expectations to become embedded into your price setting and your wage setting behaviours. Thankfully, I think, I don't think the Reserve Bank would have started panicking on Friday.
No.
I don't think the alarms would have gone off, yes, it's uncomfortable. But they're still within the band, and given that you say inflation expectations do follow actual inflation, well, the outlook is still for inflation to, ease over the course of this year back to 2%. So we're probably maybe around this peak in inflation expectations, and as headline inflation cools, we should see those expectations pare back.
Yeah, exactly. It's just timing. We had that massive shock where inflation, jumped to 7.3%. We worked our way all the way down into the 2s, which is great. And we've just had this little uptick, annoying uptick, electricity, food, rates, a whole lot of things just sort of fed through into this little bounce back above 3%, which we don't like. But as you say, the economy's been through one hell of a recession. There's a big output gap out there. That's an economist's way of saying we're sort of running below where we should in terms of growth. There's a lot of disinflationary pressure to come through this year. So are we worried? No, not yet. But I think the Reserve Bank will look at it as a bit of a warning sign, like we don't want this to continue, so maybe we should talk tough on inflation to try and beat it back down. And I think that's what they'll do. They'll talk tough.
Yeah, I reckon they can just, kind of like when you get bit by a bug and you draw a little circle around the bug bite and you just kind of watch that the rash doesn't spread past the lines. That's kind of what the Reserve Bank are doing here, right?
You're right. Yeah. You're right. And it's just gone outside the line just a little bit. It's like, hold on, where's some anti-inflammatory?
Yes.
Or some inflammatory commentary. In terms of the data we're seeing, so inflation is just disappointed, right? It's a little higher than we thought. Expectations have moved. But in terms of the actual activity and surveys, what have we seen?
Well, we are seeing that the recovery is well and truly underway. And, the Kiwi economy has really turned over. We look at things like the PMI, that's your manufacturing index, and that's been an expansion for the past couple of months. And it's most recently, it's dropped a little bit, but it has stayed in expansion and above the sort of long-term average. That's great for manufacturing. That was the industry that, is quite sensitive to interest rates and was a little bit slower to respond. We actually saw the PMI drop off a cliff last year around that tariff shock. That's made a recovery now. Services, so if we look at the PSI, which is sort of the equivalent on the services side, it's been a little bit softer, a little bit slower to recover. It is an expansion, but it's kind of just tracking along that sort of break-even point between contraction and expansion. So putting up the chart here, anything below 50 signals your contraction in activity, and anything above 50 is an expansion. I think services is just on that cusp, I think 50.9 or something. So we are seeing, promising signs, but I think it just reflects that there are still areas in the economy that are quite soft. And that adds to the point that, there's not really a huge lift off in demand. And that's also going to be keeping downwards pressure on inflation. Yeah,
and services is a much larger part of our economy, right? So it's 60, 70%, something like that. So, the fact that services is just into expansionary territory, certainly not shooting the lights out, certainly not running away, just to me highlights we're still in such an early phase of this recovery, and we really need to think, well, let's just see how the patient recovers. And come back almost in 6 to 9 months, because I think doing anything in the next 6 to 9 months with regards to monetary policy or anything else is way too premature.
Yeah, and just to your point on services, right? We've had over December, we had 95% of tourism levels back to pre-COVID times. So with such strong tourism, you'd really expect that services industry to be maybe performing a bit better. So I think that tells you maybe the lift in activity that we're really seeing from the services is coming from that tourism. But if you look at the domestic demand for services, that's probably still quite weak.
And what about the spend data, speaking of tourists?
Not looking too great either. We're not going to go into it too much.
No, I know you haven't done it.
We're doing our own. Stats NZ released some data today, but we're doing our own look at our Kiwi Bank data, but it's not looking
which
at
is better than Stats NZ.
Which is better, but showing a similar thing.
Yeah.
Just spending in December was all right, but we've kind of had a little bit of a hangover in January. So just telling you that consumer confidence, that willingness, and that maybe even ability to spend just isn't quite there yet. You've got the housing market, still really not doing what you'd expect it to do after such aggressive rate cutting.
Yeah.
Yes, that's the dynamic of, weak population growth and ample supply. But, those, we're still seeing house prices decline over the month and over the year. That's still weighing on, people's ability and confidence to actually spend when the wealth effect just hasn't kicked in.
Yeah. Yeah, I mean, it's hard for people to justify in their own minds doing an extension or putting in a new pool or renovating the kitchen when your house price has pretty much gone nowhere in the last 2 to 3 years. You just don't feel as wealthy, right? Even though a lot of it's just kind of on paper, it really does help that decision. I'm going to spend $100,000 renovating, but my house has gone down $100,000 in value. No, that doesn't make sense. So we need that to turn around.
Yeah, and when the unemployment rate is still climbing, that feeling of job insecurity is also weighs on consumption.
Yeah, I think that's massive. I think when people are getting more hours, their teams are expanding again, businesses are hiring, you feel a lot more confident in your own finances. When the reverse is happening, which I think is true, businesses are still cutting hours, they're still restructuring. I mean, we're hearing of it even today. Of course you're going to feel nervous about your own finances. Maybe you won't take that trip overseas. Maybe you won't put the pool in this year. There's a lot of flow-on effects.
Yeah, it just takes time, and it takes time for we need time for monetary policy, the accommodative monetary policy, to keep easing through and just help those sectors that are still there, because there is a lag. But one thing we don't have a lot of time for, and I'm going to ask you about your conference that you went to last week. There was some really interesting points there around, demographics. But first, I think, was it the Waikato Economics Forum that you went to? And you were on a panel. I watched. It was pretty good. What did you think? Tell us a bit about that day.
It was a great conference. It really is. Every year they get, a lot of academics and business economists and anyone with an interest in a room, and discussing really interesting longer term sort of challenges, right? Like productivity obviously always comes up. So my panel was talking about what's going on in markets and the economy, but with a tilt on productivity, and that was a theme throughout the whole conference, as they kind of always are. Like, you look at New Zealand's productivity and it has been very weak, and you go, why is that? And there's a lot of answers. The top 3 answers that sort of come up are your obvious ones. We don't adopt enough technology fast enough. A lot of our businesses aren't competitive enough, like they're not in a competitive environment, so they're not, pushing the boundaries as much. And then you also talk about education and health, and that's kind of your academic, these are the ways to tackle it, but we won't do anything about it. And then I just kind of went in and said, well, actually, I actually think infrastructure is a big part of this problem as well.
Absolutely.
Had we maintained our infrastructure and built infrastructure for, our country in 2030, 2040, we would have a much harder, faster, stronger, more resilient economy today than what we do. And that launching pad is obviously better for all the businesses, technology and everything we need to add on top of that. So that was kind of the discussion. There were a few interesting questions like, what can we actually do? And I think that's the key question, because we all know the answers.
Yeah, and what does it take as well, right? Because you made the answer so simple, right? It's like, it's not some really complicated problem that you're sitting down with a bunch of pen and paper. It's very clear. So what is the answer then to what can we do?
Well, I mean, there's a lot, and I think, a lot of it falls on the government again, which is a very hard thing for a government to do, because they're in there for 3 years. It's very hard to come out with these, 15, 20-year plans when you've only got really 3 years in power, hopefully 6, maybe 9. But they all think with such a short-term focus, it's hard to push these longer-term objectives through. So I think, more from the government, obviously, but then also enticing businesses, cutting as much regulation as you can, enticing businesses to spend more on research and development, all that good stuff, and just getting on top of our infrastructure, like just maintaining our infrastructure was a big one. For me, I think the highlight of the whole conference was Ian Rennie from Treasury. He's really got this ability to put things into the longer term, and he does think in the longer term. And he was telling us that, basically all the costs involved with an aging population is pretty much a 45-degree line, the way I can see, right? So more and more people getting pensions, more and more people requiring healthcare, more and more. And he just compared it to today to 5 years away, just 5 years away, and the amount of government revenue that will grow between now and then, a 22% portion of that has to go to the increase in people getting the pension, and just alone.
That's only in the next 5 years.
In the next 5 years.
So, that's nowhere near my retirement time.
No.
Not even really yours yet.
No.
That's really, imagine what that would be, closer to your retirement, closer to my retirement.
Oh, look, I've joked on this if some of you might remember, that I was joking that by the time I get to 65, the age will be 67. By the time I get to 67, it'll be 70. Well, now it's actually going to be 72. And then I'll still make the same joke. Hopefully I get to retire in my next life. So this is kind of what was, Ian Rennie basically came out and said, if we stay the same, we're going to have to lift the retirement age to 72. 72. So you could either do that or...
Which part of it is inevitable. Like, we will have to lift the retirement age from 65. That's inevitable.
It's inevitable.
72 right now from 65 sounds like quite a stretch. So what are the other things that we can do?
Well, just to give an idea, the age 65 was brought in decades ago when people were living to like 66, 70, right? So you got a few years retirement, whereas now you've got almost a whole working life retirement from 65. Like I think it was Ian was joking about how many people there are in that sort of 103 to 105 year bracket already. So it's not like silly to think that people are going to live to 100 plus. So yeah, big problem.
So we really need to, get our Kiwi Saver sorted.
Absolutely, big part of it. Yeah,
that's a huge part of it. But it is just such a big problem, this whole aging demographic thing. And New Zealand's not alone in the world with this challenge.
No.
It's happening across most sort of developed countries.
Yeah.
And something we've, really relied on is migration as well, right? Like what role that plays.
Yeah. Yeah. So it's funny. I wrote a note in 2016 outlining the demographic challenges of Australia and New Zealand, and I went through a whole lot of this. Funny thing is I could dust that off and update the date and then just publish it again because nothing's changed. And yet here we are another 10 years into this problem.
And it's not a problem.
It's not going away.
No, and like you said, it's not a problem for the future.
No.
It's 5 years, and then basically a quarter of the tax revenue is going towards this problem, right?
Precisely. When you need that tax revenue to be going into other areas, such a large proportion of it is just going into the pension. So you're right, superannuation is a big part. There was a good session on that at the conference and how, making it compulsory and larger contributions and all that sort of stuff. But it's not a silver bullet. It's just part of an array of things that you need to pull together to make this work. So we're going to get higher taxes some way. So maybe it's you do actually lift the GST, or maybe you do look at income tax brackets. Maybe you do means test those who go into pensions, but that's hard because you might have someone sitting in a $2 million property with zero income. So you really need to that gets quite complicated. So there's a lot that needs to happen to tackle this problem. And it was interesting being at the conference and having politicians there as well. But they all know that raising the retirement age or doing anything like that is almost political suicide.
Yeah, they're just in gridlock.
The ones who try get voted out. So, yeah. One of the solutions, though, the title of my paper 100 years ago, 2016, was Migration is the Fountain of Youth. And I said that because the migrants that we were bringing into Australia and New Zealand were kind of filling that gap, right? We've got this aging population and we're bringing in migrants generally aged 20 to 40. So it's a big part. It's also a big part of the story of the solution.
And that's still, that sort of age demographic that we import is still pretty true.
Yeah.
We've just seen that migration come off. Real quick though, you know how you said you wrote this report in 2016?
Yeah.
You should, and that you could dust it off. You actually should, because there's, for the young people out there, you know that TikTok trend where it's like 2026 is the new, like, is the old 2016.
Yeah.
And they're bringing back trends from 2016 into 2026. So I think your report needs to come, out of the shelf, dust it off and put it back out there. We are going to migration, characteristically, the people that we are getting into New Zealand, they're still quite young, but we just don't have the same magnitude recently, with weaker net migration. I think, looking at the latest numbers, we only, brought in a net migration of 14.2 thousand Kiwis over the year to December. Now, that's a bit better than the sort of 8 to 10K that we had at the sort of midpoint of last year. But that's still quite below the long-term average, which is around, call it 30.
Yeah.
So that's a bit of a challenge. And, why are they not coming? Well, it is part of the economic cycle that, there's not as much opportunities here right now in terms of arrivals. Kiwis are leaving to go to Australia or other places because of just the relative strength of the labour market. But it's really tricky because, as you say, migration is this fountain of youth. And, you actually want the government to be sort of investing in that infrastructure, investing in those opportunities that will help them solve this big problem of an aging demographic by, strengthening those flows of young migrants, right?
Yeah, absolutely. Like, how do we attract the best and the brightest? Because we're losing the best and the brightest.
Yeah.
Right? We educate our Kiwi children, put them through great schools and universities, internationally recognised, and then we lose them. But then it's about, well, let's get some bright minds coming the other way. And I haven't seen a lot of analysis on this. I guess it's hard getting the data, but, are we getting like for like, or are we getting something different? And I'd argue we're getting something different. So we're probably losing out on one side, gaining on the other, but it's a completely different mix.
Yeah. I mean, obviously, our migration in New Zealand particularly is very tied to the economic cycle. So what we're seeing right now isn't necessarily this new structural shift. And, as things in the New Zealand economy improve, we should see more normalisation, net migration back to long-term averages. And we're already seeing, a levelling out and arrivals are starting to gradually pick up and departures are sort of stabilising at their high levels. So it's not getting worse, and that should only improve as the economy recovers as well. But it is thinking about that long-term thinking of, how do we leverage New Zealand, all that New Zealand has to offer to, help get that strong flow of migrants and help tackle that ageing population story.
Yeah. I think one thing that surprises me is just how short memories we have.
Yeah.
Like, people at the conference were really concerned about how, our migration has cooled the way it has. And it's like, well, wait a minute. We had the largest spike in migration in 2023 ever recorded in 1 year. Sure, that was a COVID thing. But prior to COVID, from 2013 to 2019 was the largest migration boom in New Zealand's history. Like, huge, massive, right? We're going through an economic downturn. Things will recover. Things will get better. And New Zealand remains an incredibly attractive country. It staggers me that people get so caught up in what's happened in the last 6 months. Actually, I'd argue this time next year, if we've recovered the way we have, and the Aussie economy is probably cooling actually because of rate hikes over there, then there's no reason that can't, move back in our in our favour.
Yeah.
And we won't be complaining about it. Now, what would be interesting is if that timing is just right, because I think in a year's time, our firms are going to be hiring more.
Yeah.
So the more they're hiring, the more they're attracting, migrants from overseas. So, yeah, let's have this discussion in a year's time. And our prediction is that the migration numbers would be back at what? Plus?
Say plus 20, 25K a year.
Yep, that's not bad. Is that long-term average?
Long-term average is around roughly 30-ish.
30, okay, so slightly bit. Let's make it 30.
Okay, we'll
28.
go 28, okay. I'm just being on the
We're close.
side of caution.
Yeah, and I need to push the boat out a little bit. Okay, we'll see you in a year.
All right, mark the calendar.
Yeah.
And that's
Exactly.
us. Nothing. I think that's us, right?
Yeah, I guess I got nothing else to say.
Mark the calendar. I think that's the perfect way to end.
Why not? Yeah.
I'll go back and put a little note in my Outlook calendar.
And with that, house prices would have lifted 2 to 3%, according to our forecast.
Yeah.
GDP will be running about 2 to 3% as well, I guess.
Yeah.
Yeah. Unemployment rate would be down to
sub 5, so maybe mid 4s.
Okay.
Yeah.
4.5%. And what else do we want? And the Kiwi would be at least 63 to 65 cents.
Sounds
Done?
good. Yeah.
All right.
No pressure.
Can we delete this episode if it doesn't come? Yeah. All right. Cool.
Yeah.
Fine. All right. Thank you all for joining us today. Geez, we got through 25 minutes really quickly. Thanks for listening, and we really appreciate you following us. Please subscribe if you haven't already, and forward it to your friends. Let's try and get this following going. Thank you. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.